Market volatility changes what investors are buying and how we do business. Most people watching this know that I'm the ground up construction guy, from residential to multifamily, ground up, build and hold. And it's something that has evolved over the years. Now, I'll tell you, in 2016, when I first started doing this in scale, we started buying single family and multifamily rental homes to save our asset portfolio back in 2010 from the 2008 recession. We actually started in 2009. But as that scaled and grew, I realized that I found something in the multifamily space that continued to produce revenue in spite of recessionary markets. And so I continued to invest in multifamily real estate. By 2016, we said we need to start investing in larger assets, 100-unit assets, 50-plus unit assets. So we went after that stuff. And as we started shopping and the market was paying 8% cap rates, I started seeing cap rates compress from 8% to 7%, 7% to 6%. And at that time, the rent rates, the valuations were in excess and pushing, either pushing up to or in excess of where they were in 2008. And so in today's video, I want to explain to you guys what's happened because of increased interest rates and how it's affected cap rates and how cap rates have affected values and how you ultimately can benefit from it right now. And so this is what we've been talking about since early 2018, when I noticed it for the first 2 years of 2016 and 2017, and I started seeing cap rates compress, and I knew that once values hit in excess of 2008 numbers, where the market was at its peak, that things were going to get very fragile in regards to where we were. Because I knew that if you look at history, ladies and gentlemen, you know that about every 10 years, about every decade, the market tends to dip and there's a market adjustment. Now, I didn't know how big that market adjustment would be. I didn't know if it was going to be catastrophic or if it was going to be something small. All I knew is that if you look at history and you turn back the hands of time over the last 100 years, about every 10 years, we have a market adjustment. When numbers started pushing past the financial crisis of 2008, I knew that I needed to start looking for a different means. So in 2018, we decided to build new construction, ground up, build and hold. And so we started pulling brand new construction developments out of the ground with 100 units plus in the multifamily sector, and decided to go after the affordable housing sector, knowing that that is what's predominantly needed in 2018 and still needed in 2023 and pushing forward into up and coming years. Now, people would ask me, Jerome, why do you build over buying? Because building takes longer. And I told them market volatility, because market volatility wins all the time. And I warned people in Real Estate Domination 2019 in front of a room, telling them that, look, the market volatility is real. It's going to happen. There's going to be a time where interest rates go up, cap rates that are compressed right now are going to go up, and valuations are going to drop. And so if you don't know how that all works, I'm going to recommend a video of underwriting right after this video that you guys can watch, and you guys can click on it at the end of this video. And if you like the content, click and subscribe to our YouTube channel and pound that thumbs up button. Now, here's the market circumstances today. We are slowing down on the ground up development for at least 2 years. We have developments coming out of the ground, and we have about $150 million of it. We're going to continue these projects because these projects are financially viable, they're lucrative, and long-term, they're going to be the winning assets of everything that we're doing. But I always tell people, it's not whether you should be buying or not in any market when there's market volatility. It's what you're buying and how you should be buying it. And so right now, ladies and gentlemen, is a massive pivot in the market. And if we don't pay attention to it, that meaning me, myself, my company, teaching you, yourself, your company, what the market volatility brings as far as value to you, I'm doing you a disservice. We might as well shut down this camera and stop watching. And so today I want to share with you guys why there's opportunity, how the opportunity exists, so when you look at it, you can pinpoint it and realize it. So get out a pencil and paper, because I'm going to give you some key components for your underwriting that'll really move the needle on how to find specific multifamily deals. And here's the kicker to it, is that I need your help. We are on a mission right now to go out and start picking some of these assets up, and we need bandwidth because we've been looking for land to be able to build multifamily, ground up, build and hold. We get land deals coming across our desk every single day. But along with these land deals, we're going to continue buying land. In fact, we're going to buy land that people can't build on, can't get loans on, and projects are dead at discounted prices. 50 cents on the dollar and even greater in some instances. So land deals are great. But the asset class that I want you guys to focus on is the exact opposite of what I'm telling you guys to build. Okay, and it happens in the exact same sector of what we're doing in the single family market. I tell you guys, do not compete with the median home buyer when you're building ground up construction. Why? Because the median home buyers are the one getting affected by the volatility in the market right now. The upper 24% are the ones that are going out still buying homes. That's the market sector you need to focus on. Although when you go in and you're investing in rental properties, you should be buying median homes all day long, because that's what you can rent at an affordable price to the masses. Hence, multifamily affordable housing, a product that can rent for less money, is what you should be building. But if you're buying new, the tables flip, because everything goes into financial distress when the tables flip. And right now, Class A fully amenitized multifamily is what we are looking for. And it's something that you should be looking for, whether it's a 4-unit, a 6-unit, a 10-unit, a 15-unit. Those are available in your city right now. And what you're going to notice is that in spite of what had happened in prior years where you couldn't find any of this, investors were flocking and fighting over it, you're going to notice that investors are flocking away from these assets because the cap rates that were compressed and the owners that over-leverage themselves can't sell for a valuation that even makes sense. And here is why. Because, ladies and gentlemen, when a cap rate, for those of you guys who don't know, is the rate of return you get on an asset when you pay cash for it. So if you go in and you pay $100,000 for one duplex and you have a 3% cap rate, that 3% is what you make on your $100,000. Now, if you go in and that cap rate goes to 6%, that's the return you make on that asset. Okay? Now, when cap rates go up, valuations, believe it or not, they go down. And so the reason why is because now the expelled capital that's going out is in excess because you're paying a higher interest rate. And so I've always told people, interest rates and cap rates, they run in parallel to each other. You can't service the debt on a 7% interest rate with a 3% cap rate because there's a 4% spread between the two, and you're servicing debt, you're servicing a gap between your debt and your return. So when you service debt and you have a gap between your return on investment and the actual value of the asset and what you're making, somebody has to go in and service the debt in between it. And this is what happened to me in 2008, is that I had commercial properties that were losing tenants. The cash on cash return diminished, but the interest rates went up. My cap rates also went up, my return went down, and I had to service the spread. So the way I serviced that spread is by buying distressed assets that were still cash producing to service that spread for me. So it was a grind and a hustle. Nobody wants to have this asset, which becomes a liability, and then go buy a bunch of other assets, take the money from these assets over here to service the debt on this asset. And so these large assets right now are becoming liabilities. And because they're becoming liabilities, what's happening is the values are now starting to drop in parallel with the cap rates going up alongside of interest rates. So here's what it means to you, is that we're looking for these assets. We want Class A amenitized assets that people paid sub 3% cap rates for. They had what's called an adjustable rate, mortgage, okay? It's an ARM. And the most popular ARM is what's called a 5-1. And a 5-1 is an adjustable rate that after 5 years starts to fluctuate. The first 5 years, it's fixed. So most syndicators, most investors, the mistake they made is they say, well, we'll only be in this asset for the next 3 or 4 years. So a 5-year ARM is perfect. I'll get a better interest rate doing a 5-1 adjustable rate mortgage today. It'll save me money because I'll make more money on my cap rate, servicing the debt with a lower interest rate, and hence it works well when the market's doing extremely well. But the only problem is when there's volatility in the market, values drop, and you can't get out of your mortgage, what ends up happening is they land up defaulting. And so right now, ladies and gentlemen, what's happened with the market is that there's so much volatility and interest rates have went up. There is leverage of 5-1 adjustable rate mortgages all over this country and all over the world. Okay, so take for example, right now, here's what brings the volatility in the market. So when an investor goes in and they can't refinance, they're at a place between a rock and a hard place. They went out, they did a 5-1 adjustable rate mortgage. And with right now, values are compressed. So what I was talking about earlier is, let's take an example of a 50-unit apartment complex that rents are just over $1,800 a month. Let's say that they have a gross operating income of just over $1 million a year. With assuming a 40% for expenses and maintenance, that's going to be a net operating income of $615,000 annually. So if you function on your 95% occupancy rate and a $615,000 net operating income, and you take a cap rate, ladies and gentlemen, of 6%, okay, the value today is going to be $10,260,000. Now, when they went and got that initial loan, if you'd multiply it by a 3% cap rate and you take the same rent values of $615,600 of net operating income and you multiply that by a 3% cap rate, that means the value of that property is $20,520,000. Now, if you go in right now and you leverage your property that had prior been worth $20 million based on a 3% cap rate, and now you go in at a 6% cap rate trying to serve interest on a 6 to 7% loan, and the valuation is 50 cents on the dollar what it was just less than 2 years ago. And so if people come in with a $10 million valuation, here's what happens, is that banks today are not lending the same amount of money as they were just a year and 2 years ago. In fact, banks were giving out 80% loan to value. So on top of what people were getting on their mortgages just a couple years ago, they can't go back in and get even the appraised value today based on interest rates and cap rates. And now they can't even get the quantity of money that they were getting just a short year and 2 years ago. When lenders were willing to give 80% loan to value on $20 million, let's take a look at that. We take 20 million times 80%. The banks at that time were willing to give $16 million on that loan, which means that the investor only had to come up with $4.5 million as a down payment. Now look at today. They have a valuation of $10 million, okay? So $10.2 million. They have a $16 million loan, ladies and gentlemen. And today, the reality is that banks are really giving between 60 and 70% loan to value. So let's give them the benefit of the doubt and say that they have the most prestige financials and the most elite experience in the market, and they go out and get 70% of a $10.2 million loan, $10,260,000 times 0.7. That means they're willing to give on that same asset they lent just a year and a half ago, $16 million on. The banks today are willing to lend you a hard $7.18 million on that same asset, based on a 3% to 6% spread on interest rates alone, presuming that cap rates run in parallel, which is exactly what's happening to the market today. So what I'm telling you, ladies and gentlemen, is yes, this is the type of assets that we're looking for today. Why go in after just affordable? Go in after the biggest, the baddest, and the best assets you can, because this may be our only opportunity in the next decade or longer before we start seeing compression like this and volatility in a market. And this is where wealthy people get extremely wealthy. You only need one downturn in the economy to go out and start getting wealthy, ladies and gentlemen. So for you, those of you guys who are considering building ground up multifamily, start picking up land at a discounted price, start entitling it, drag your feet, and just get it ready. Because in 2 years, ladies and gentlemen, the construction ground up game is going to be as plentiful and aggressive as it is today, and better. because the volatility as it sits today isn't going to last forever. You're not going to see $20 million assets worth $10 million for a long period of time. And the reason I know this is because no matter where you go, no matter what you research in regards to affordable housing and the needs for rooftops, that we are still 4.7 million rooftops short of where we need to be. And so I urge you guys, if you're an investor, aspire to be an investor, stop sidelining the game. The game is going to be played with or without you. There's people like me that are aware that the game exists. And now you have the exact same awareness that I have. And some of you guys that are already investing already understand that this is happening. It's time for you to play ball. And for those of you guys who don't have the financial means, don't have the resources, have the information, the wisdom, and the knowledge, and just want a shot at it, this is your chance. I'm doing an outreach to you right now telling you, bring us these assets. We'll bring you in as equity partners on some of these assets so that we can come in. If you have the ability to raise capital, if you have the ability to find and locate distressed properties, we want you. We need that legwork and we need that bandwidth. We are going to expand, grow, and we're going to annihilate this market. We have a 2-year window, ladies and gentlemen. In 2 years from now, as interest rates start to level out, cap rates start to level out, values start to level out, and all these distressed assets start to flatten out, the same opportunity that exists right now and that we're on the forefront of will not exist in just a couple short years from now. And so it's a short-term play for a long-term gain. The question is, how will you play? Be on the sidelines cheering on LeBron James and the Lakers towards the finals? Or are you going to be somebody that's going to be in the game? Are you going to be somebody that's on the field, on the court? You can be a spectator watching and cheering us on, and we'll take your cheering, we'll take your advocating, but why not be the resource that's actually gaining and benefiting from everything that's happening today? Ladies and gentlemen, because of the volatility in the market, you got a 2-year window. Bring us the assets, you yourself invest. Let's crush it over the next 2 years. Now is the time. Invest and go out and compound your success. And don't forget, click and subscribe to our YouTube channel, hit that thumbs up button, and we'll see you next time.